our next speaker is going to be introduced by Ruth Ribeiro from my team. So Ruth, over to you.
Welcome, funding-focused guests and speakers. Our next speaker is all the way from Silicon Valley, and his name is Spencer Greene. Spencer is a general partner at TSVC, which is a seed stage venture fund in Silicon Valley. He has spent 25 years working in the technology industry and 12 years in executive roles at Juniper Networks. For the last 15 years, Spencer has coached presenters on how to pitch products and companies. Would you please put your hands together for Spencer Greene? Thank you.
Thank you, Ruth, and nice to meet everybody. What I have today is a talk that I've done at a few business schools and entrepreneurship conferences called How to Pitch Your Early Stage Startup. And let me share my screen here. Oh, I think you need to enable me to share my screen if you don't mind. And I will give a little preview that this is a series of tips and tricks. We see at TSVC, we see about 500 to 600 pitches a year. And there's some things that I've discovered over the years of seeing them that may be obvious to everyone else, but these were learnings for me. So I thought I would share them as ways to help you make your presentation stronger and easier for a venture capitalist to digest. And I'll say that this comes from a very particular perspective. As Ruth mentioned, we're a seed stage investor. We're based in California, and there's a particular style that I think we're representative of. So some of the things that we say are going to be not valid for other style of investors, but I'll give you a perspective as we see it. So the summary is, 4 things, right? One is find the right type of investor who matches the style of business that you're running. Second, and most importantly, a clear, concrete, and compelling story. And I'll talk a little bit about that. But you would be surprised at how many companies we see, again, after 500 or 600 pitches in a year, how many that we as partners, after the meeting, we disagree with each other about what the business is. And obviously, some of that's on us. We're perhaps, just not as clever as we think we are, but also it's, you have to understand the perspective that the audience is in and leave them with something that they really understand. Third part, be ambitious, I'll talk about, and then describe a little bit about the deal. So one of the things that was surprising to me, I had done angel investing for a long time. I had been involved in startups for many years and founded several companies. I didn't entirely appreciate how narrowly focused most venture capital firms are. So I had introductions, or I had names, I had people I knew. I said, oh, you're a venture capitalist. Let me pitch you my company, one of my startups. And what I came to realize is that folks are very narrow in these 4 dimensions: stage, sector, geography, and special situations. So I'll send these slides out. But what we're seeing right now in deals that we do is, and these metrics have moved over time, but you have funds that, like us, focus on pre-seed and seed. And these are going to be valuations between 5 and 15 million US dollars, somewhere between 250K and 5 million round size. And you have investors that focus on the A round. And then of course, there's folks that are much later stage. And the structures vary depending on what stage you are. So finding an investor who's at the stage that you are, these are initial screening questions, right? So if you're approaching a number of different investors, then we have an intake process where we first screen out, okay, is it the right stage for us? Then we look at, does it match our specialization? In our case, we're sector agnostic, so we have a number of different areas that we work in. But there are definitely funds that specialize in fintech, specialize in digital health, and so forth. And then geography, There used to be what was called a 20-minute rule, right? That an investor only wanted to invest in companies that they could drive to within 20 minutes. And that has been, even before COVID, there were changes that happened starting about 10 years ago in a founder-friendly movement that was led by Andreessen Horowitz, more or less. But certainly in the pandemic, where so much business is transacted virtually, the 20-minute rule mostly doesn't apply. However, there are particular constraints and biases. For example, as a US investor, we prefer US corporate structures. So we have businesses, we have a company in Africa, but they have a US Delaware corporate structure. They're doing business in Nigeria, as it turns out. And we have other companies in other geographies with US structure. There's also a trend I'm seeing, which is the plan for B round inversion. So this is a company that maybe starts in another country and they want to raise capital in the US. So at the early stage, they will say, okay, we're currently incorporated in Germany. We're currently incorporated in Australia. We're currently incorporated in even Canada. And they will have a plan that says, you know, once we raise our B round, sometimes A round, we have the intention to invert the company, have a US parent to access US capital markets, and then make our overseas operation, which is the principal operation of the company, into a subsidiary. Obviously, you don't have to raise capital in the US, but if you're looking to raise capital in the US, it's likely that folks will ask you for that. And even, for example, Y Combinator, which is doing a lot more international business, especially in Latin America, they require, I think, a US Delaware structure. And then one of the reasons why geography is still an important aspect of how venture capitalists constrain their portfolio is that we've seen a lot of businesses that have success in another geography, and they say, oh, well, here's our numbers, here's our success in our home country, and we intend to launch in the US. And over our 10-year history, we've seen most of those fail. So for us, you know, we look for, if you have a target market that's your destination, we look for some early traction in that target market as opposed to just a plan. So the next piece of what I coach people on is telling a compelling story. And you know, there's a number of interesting books. My favorite is called Made to Stick by Chip and Dan Heath. And they talk about a framework where you have a simple, unexpected, concrete, emotional, and can't remember the last one, but it's SUCCES, success, right? A thing that some people who are telling their company story forget is that this is a hero's journey. The hero is not your product. Folks get oftentimes too wrapped up in their product or service, and the hero is not you necessarily. The hero is your customer, right? So, and this whole thing about clarity, when my partners and I leave a meeting and we can't agree on what we think the product is, it's often because of an issue at this step in the presentation. Now, as a presenter, there's a phenomenon called the curse of knowledge, right? So you know your subject so well that you may skip steps in explaining it, right? But we're coming in and in a given week, seeing 15, 20 companies, it's easy for us to get confused. Sometimes, you know, oh, was it this company or that company? So simplifying it as much as possible. And then most importantly, I think, making it concrete. So if you have a customer persona, if you have even give the person a name, right? And say, hey, you know, what my product is great at, it's helping this person do this thing. And before they did this thing, right? Before Airbnb, you pretty much had a choice. You could stay in a hotel, or maybe you could go on Craigslist, but you didn't really feel comfortable or safe renting from somebody on Craigslist. Now with Airbnb, you have access to all the the spare rooms in the world, right? So something that will tell me exactly what's the before and after. And as I mentioned, it really shocked me to see how often the basics of the business didn't come across. So I would also say simplify, simplify, simplify. We have particularly folks who have an engineering background when they present a company. They like to tell every possible aspect of the story and corner cases, what if this, what if that, and then the central theme gets lost. So it's okay in an early story to just hit the high points and then invite questions, for example. So this is one that I think is really important, that when we evaluate a company, and I think this is true of any investor, right? We look at the team, the technology, and the product, right? So we look at the market, right? We want to understand, is this an opportunity that's going to be sufficient? We look at the business model, all these things. However, particularly for us as early stage investors, it's really all about the entrepreneur. And I'll tell a story. You can see behind me some of the companies that we invested in at seed stage. So Zoom, when we invested in 2011, their business model was not what it turned out to be. However, the entrepreneur was someone that we as a firm believed in. And we said, this is a person who, as the world changes, as the opportunity changes, as as more is learned, he can figure out what to do next. So the investment was in him. Now, in part, of course, we're interested in the nature of the business, but more importantly, we're looking at many of these aspects of the business as for how they reflect on you as an entrepreneur. So for example, if the market is a strong market, then what that says to us is, okay, this is an entrepreneur who has chosen a strong market, someone who has both the analytical skills to understand what a strong market is, and someone who has the ambition and the choice to pick that market, right? And if we say, hey, you have a revenue plan that no one could possibly execute, then we're not really complaining about the revenue plan. We're complaining about the judgment of the person who's presenting a revenue plan like that. So ultimately, as much as we like to portray ourselves as hyper-rational, the full meritocracy, right? I mean, this is the myth of venture capital investing. And I know you've heard from the first speaker about some of the biases that are inherent in the industry. Ultimately, when it's all said and done, if you like the entrepreneur as an investor, then that means you like the deal. And it's not the other way around, right? We think that, if the market is very attractive, if the product looks very clever, but we've passed on deals where we were just blown away by the product because we couldn't get comfortable with the individual. And conversely, we've done deals where we said, this product doesn't quite look right, but there was self-awareness. The entrepreneur understood that it wasn't right and said, this is a starting point. I'm going to figure it out. And we said, yeah, we believe you could figure it out. So the third major point, and this is a tough line to walk sometimes, for us, and I think for most venture capitalists who are in the same sort of sector that we're in, we only will do deals that have the potential to be 100x return, right? And there used to be guidelines about 10x return. 10x is not nearly enough to make the business work, because for us, for example, we tend to take very large risks against opportunities that are enormous. And so if we do a 50 company portfolio, we expect half of them to fail completely. Now, in order for that model to work, we have to have some that do very, very well. The Zooms, the Cartas, the Ginkgo Bioworks, right? The challenge there is that if you're entering a very large market, then you risk coming across as impractical, right? So there is one strategy. It doesn't work with all businesses, but there's one strategy that has been very successful, which is to do things in steps, right? So if you say, hey, my intention is to build a million mid-market sedans. So that's my goal. And I would say, even when you're presenting, tell that part first. Establish a vision, say, hey, this is where we're headed. Now, in order to do that, I first need to build a luxury sedan. And in order to do that, I first need to build a small two-seater, right? So now we have a picture of where you're going. We know it's ambitious. We know that the intention is to build a million of something, right? And you say, look, I know that I can't jump from the beginning to a million mid-market sedans, but I have a way to get there, right? And we've seen, so Carta was one of our investments. They started with a very modest product. It's a product that many startups use to manage their cap tables. Their ultimate destination, and the reason they've been so hot in the market lately, is that what they want to become is the stock exchange for private company shares. But they didn't begin there, right? And similarly with other businesses. So one approach you can take is to take things in steps. And then just a little bit on deal structures, what we're seeing now at the early stage, at the seed stage. In the US, this is obviously an overgeneralization, but most of our seed stage deals that we see are on a safe structure. So this is a simple agreement for future equity, and they tend to have a cap, no interest and no discount. Interestingly, in the US, on the East Coast, and more of the deals we see that are overseas, not in the US anyway, tend to be on a convertible note with interest and discount and a cap. And then obviously, later rounds and some earlier rounds are priced. My only suggestion there is, there's a quite simple standard structure. You have a price, you have a share. We see people trying to get clever with warrants and other kinds of crazy things. And I would say there's no need for that. These deals have been done 1,000 times, and innovate on other things, but not your deal structure. And then a trend that has changed over the last 10 years is, it used to be quite common, I would say almost universal, when raising a round, to just say, hey, I'm raising money. I think I need somewhere between 2 and 4 million, and then really let someone offer a term sheet to you. And that still happens, and particularly, again, in some geographies, it's more common than others. What we've seen a lot more of is companies that are setting their own terms. Now, oftentimes these terms are not completely solid, but they're presented as solid. So a company will, even with nothing, right? They come in, they have basically just a PowerPoint and a team of 2 or 3 people, which is the stage at which we often invest. And they'll say, I'm raising 3 million on a safe with a 12 million valuation. Now, they don't state that as a negotiable term. They just state it as flat out. In many cases, if there's not already a lead who's signed on, it turns out to be negotiable. But the trend that we're seeing is folks that, and it does help us to simplify in some ways our screening. So we can say, yeah, this fits our profile, it doesn't fit our profile. It's also, in many cases, we also see folks who say, yeah, we don't know what the terms are yet, the lead will set them. Now I'm jumping around a bit, trying to keep it brief and then leave time for questions, but I have a lot more that I can say about all these topics, and actually each one of these slides could be a 20-minute presentation. So last thing I'll say in this session, in the prepared remarks, is when you get a first meeting with a venture capitalist, I think there's 3 things you're looking for. You want to learn about who they are and figure out if it's worth it for you to continue talking to them. And that's the same thing going on the other side, right? And then again, given that, so we do about 1 deal a month on average for us. and I think we're fairly representative. So we're doing 12 deals a year. We see maybe 500 pitches. So it is important on both sides to make a quick assessment whether this is something that's worth taking more time in. And out of those 500, there may be, let's say 50 or 75 that will take a second meeting to get down to 12. So on both sides, you want to do a fairly quick assessment. And if it's a firm that you think you'd like to work with, then the important thing is oftentimes there'll be several people in your meeting. Someone within the firm has to be your sponsor, right? So they're the person, they're not necessarily in a position of authority to do a deal. They can't write a check, but it's someone who says, you know what, I want to hear more from this company. I want to do the work to understand them better. And if you can catch someone's attention within that first meeting, then, and if you decide that they're worth talking to on an ongoing basis, then that leads to the second and third meeting where the focus is very different. So who are we? We are based in Los Altos, California. I'm actually calling from Palo Alto right now. And as I mentioned, stage, sector, geography. So we do seed and pre-seed. Our sector, we're not completely agnostic, where there are particular areas, deep tech, fintech, and digital health are the areas that we tend to like. And we like US domiciled companies. And we have done almost 200 deals since 2010. Some of the big ones you see here, 7 unicorns, which we think is a leading number for a seed stage fund. And we've had so far 28 female founders, and hope that will be many more. Of our unicorns, by the way, Zoom was founded by Ritu, and Quanergy has a female founder whose name I unfortunately can't pronounce. It's a Chinese name. And Ginkgo Bioworks, a team of 5, which is a mixed gender team. And that is us.
Brilliant. Thank you so much, Spencer, for sharing that. And we're a little bit tight on time, but we've had one question come through from Amanda. When you're looking for 100x return, what's a realistic time frame that you're looking at?
10 years.
10 years. And so would you want to see financial modeling done out for a 10-year period?
Oh my goodness, that's a pet peeve. No, I mean, Apple can't predict their revenue for 1 quarter. How is it that a startup can predict for 5 years? No, we look for a large market opportunity. So if you say, you know what, there's at least 30 million people who need this, and they'll pay at least $20 each. Okay, that's enough. Modeling your revenue for me is just ridiculous.
Yep. Okay. Brilliant. Thank you so much. And Spencer,
sorry to run over.
No. That's fine. That's fine. It was brilliant to hear, and such valuable content. And I've already made a few notes of things that I'll repeat in my closing address. So thank you so much. Great to have the perspective of a Silicon Valley investor, which is our first time. So most of our investors so far have been from UK, Europe, and Asia Pac. So thank you very much. And in terms of if people want to reach out to you, is LinkedIn the best way, or what?
LinkedIn or email, and I will quickly put this up.
If you could
again.
just put those in.
And again, you'll get these slides, but this is me, Spencer at TSV Cap, or LinkedIn, Spencer Greene.
Fabulous. Wonderful. Well, thank you so much. And I hope you can stick around with us. I know it's the beginning of your day, but I hope you can stick around with us and, maybe stay for one of the breakout rooms and see what happens. And, but Spencer, thank you so very much